I want to pitch how to build a directional trade on IWM. Okay, so the premise here, the premise, this is part of the thought process for putting together a trade, is I want to be I want to play the small cap catch up trade. Okay. And I want to do it in a manner where I want to go directional. And anytime we say I want to go directional, essentially what that means is I want to build a trade where I have more upside and I'm okay if it's a lower probability. Okay. Because generally that's the trade-off, or that's the question when you're building an option trade. Do you want a higher probability, but are you willing to accept a lower payout? Or do you want to go for the gusto and shoot for a higher payout, but recognize that it's a little bit lower probability? Those are always connected. I want to give IWM a shot here, and I want to get paid if it works, and I want to get paid pretty well. So I got to go the directional route for that. So we're going to use, so the pattern here, right, is we have a breakout in IWM. Okay. The challenge is you're kind of 3 days into the breakout, but it reset on Monday and then kind of rebroke out yesterday. So let's just say we are 2 days into the breakout. Okay. And percentage wise, it's more, if it was two small candles, it wouldn't be that big of a deal. We're just two pretty big candles into the breakout. And so you really have a choice here on the timing, right? Your timing choice is A, wait for a pullback, a flag, a pause to develop, right? Then trade the next pattern. Or you say, you know what? It's more important for me to get something on the board. Sometimes if you want the exposure, you can't be overly picky. Either you want the exposure or you don't. And when your objective, when the thing that you desire is more just, I want to play more so than I want a perfect setup, sometimes you do something just to get it on the board. So the other option is just get in to get the exposure and trust the original, forecast, which is that the rotation in small caps has legs, which is that even if it does pause or pull back, I think there's a second leg up. And so even if we got to sit through a little bit of pause, I think I'm going to get another move higher. And by the way, in situations like this where it's hard, where it's like, hey, part of me doesn't want to miss out, so I want to get something on the board, but part of me thinks it could pause or pull back, so I want to feel like a schmuck because it goes down after I get in. Remember, you can always have your cake and eat it too by scaling in, maybe do a partial position to get something on the board. And then if it pulls back, you can add. So I don't have a strong opinion here in IWM. I do think it's safer to wait for a pause or a pullback, recognizing that if it pulls the NASDAQ and doesn't really let you in for a while, you may just be looking on from the sidelines. So what strategy do I want to do? Just as a side note, part of the intent with today's lesson is to teach you how to go from a premise, a bias, to the pattern, to the strategy, and make sure that the option strategy you pick fits the mold, right? It checks the boxes you're trying to check. I've already said I want to go directional. I'm not going to sell a put if I want to go directional. I'm going to buy a call option or do some kind of call spread. And so with IWM being $185, a long call, it's cheap because volatility is low, but it's priced as if the underlying is $186, and so you're going to pay a little bit more. So a bull call spread offers a lower cost alternative to long calls, but still has a pretty good amount of upside. Okay. And there's two ways you can structure this, right? You can go big and build a, maybe like a $10 wide spread with a 25 net delta where you have a lot of exposure. Or I think you could just minimize the cost by maybe doing just like a $5 wide spread to make it cheaper. Okay, cheaper. I actually want to illustrate the $5 wide just because I like the structure right now with IWM. So basically what you're going to do is you're going to buy a lower strike call and you're going to simultaneously sell a higher strike call. And that creates what's known as a vertical spread. It's also known as a vertical debit spread. It's another way of referring to a bull call spread. But I'm looking at the chart of IWM and I'm thinking, okay, so I think it could get up to 190. And so one way I can profit from that is to set up a spread that maximizes its gain if you're above 190. So what if I just bought the 185 call and sold the 190, as opposed to maybe buying the 185 and selling the 195, which I think also works. Okay. You come into the trade tab. I would go out. I'd give this some time. I'm going to go to July. It's funny, based on the last couple of days, it seems like we're going to hit 190 tomorrow. I think 44 days is plenty of time, because even if it pauses or pulls back, you got time to let it work. So we're going to go find the 185 call. I'm going to buy that. Click on the ask price. I'm going to sell the 190. Okay. It's going to create a $5 wide spread. Net delta is only about 15, so it's not as aggressive as if I went $10 wide, which again, I think it's preference here. And I'm paying $273 for a $5 spread, which means I can make about $223, I believe. $227. So you could skew it a little bit by buying maybe a 286, selling a 191, or sorry, a 186, selling a 191, or maybe a 187, 192. You can fudge with the strikes. The more important thing for me is just understanding the trade structure. But when we talk about having more potential upside, you're getting almost 100% potential return, 227 over 273. Yeah, 83% return. You're not going to get an 83% potential return with a naked put or with a bull put. And that's not what I'm seeking, right? I don't want the higher probability in this particular hypothetical. I want something that's got a lot of upside. And it illustrates the leverage as well. I mean, the fact that this can go up $3.15, which percentage-wise is 1.7%. Stock can go up 1.7%, and I built an option trade with the potential to generate an 83% potential return, is a massive amount of leverage. These at-the-money bull call spreads, if they work, and if you ride to expiration, you're talking about a very small move in the stock generating a very large move in the option, which is accomplishing my objective, which is I want a bigger potential upside, right? If the trade has legs, I want to fully capitalize with something like a bull call spread. So there you go, bull call, IWM, little at the money, 6 weeks out or so with July. I think that's an interesting way to build a position around IWM.